What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team ranked #1 on Wall Street in the All-America Institutional Investor Research Survey.
Alex, thanks so much for being on the show today. Emily and I were talking and shocked that it had been a year ago you were on. I thought it was only a couple of months. So we are long overdue to have you back and super excited to talk with you today.
Thank you, Steve and Emily, for having me on. I didn't realize it was that long, but to me, when I hear podcasts, it's still a new, exciting platform. It's always fun to come on.
So a year ago when you were on, you were talking about how there was parts of the REITs segment that you were very optimistic and bullish on. And you had the quote that REITs in general were still, at that time, a really big question mark for investors. It seems in the subsequent year that has happened, investors have come along to your way of thinking, and you saw an incredible run in the sector, especially at the first half of this year. We have seen since about mid-July a reversal in that. So we were just wondering if you could give us an overview of what has been going on in the space and why you did see that reversal and what your thoughts are from here.
Sure. So we've been on this lack of supply theme almost since the pandemic. I remember playing golf with with a retail REIT, with actually the Kimco CEO. I think we were heading to the 7th or 8th hole at his club. And I mentioned to him that shopping centers had this great opportunity because everyone was locked up at home and shopping centers were the only sociable, acceptable place where you wouldn't get arrested if you went out and left your house. And oh, by the way, nothing's been built in 15 years. And he was appropriately dismissive because obviously a lot had gone on at that point and things were shut down. 6 months later, they went out and bought Weingarten. I texted him the day they announced it, and he's like, yeah, things have changed. My point is that coming out of the pandemic, we saw that there was a lack of supply, first in retail, and then that extended to other asset classes. We are now done with the apartment oversupply. That was in 24, 25 was this massive 2x delivery wave that occurred, and we're finally on the back end of that. Still dealing with some residual fallout in the Sun Belt, but apartment starts, I think, are down 50% or so. Industrial during the pandemic had this huge supply wave. Everyone was building these massive warehouses for Amazon and other distributors who were getting product because either one, you couldn't ship enough products, so there were people just needed storage space, or two, everyone was ordering stuff for their homes during the pandemic, whatever it was. All this warehouse building, that stopped as well. Office, we went from people feeling that no one was ever again going to commute into the city. It was going to be work from home forever, empty office buildings. These things were going to be strewn on the streets like confetti after a parade. Fast forward, you can't touch office space. Today on Park Avenue, if you look around, each tenant padlocks their door and puts chains around the handles, because if they don't, the next morning someone else will have moved into their space. There is such a premium on premium office space, and you're seeing the market tighten in a way that has never been, as our president would say, never been happening before. Why is this the case? Because the pandemic changed a bunch of things. As far as office goes, yes, the cities have made a comeback, but it's placed a real premium on high-end office buildings that are commuter convenient. And at the same time, you have legacy office owners who are still upside down with their loans, so they don't have money to invest, or people who own generic, nondescript office buildings that no one wants to be in, or to mid-block building with no views and therefore no one wants to be in. So the market has self-selected. You go to retail. If you go back over history, and I forget if we spoke about this in the podcast before, but if you went to the 60s and 70s, you had the proliferation of the interstates and all these new suburbs after the war and Second World War, that is. And you had all these malls being built. You had Sears, you had Kmart, Woolworths, all these stores that were opening up across the country. Then that morphed into the Walmarts, the Targets, the category killers. And then that morphed into the housing boom before the GFC, when all these new communities were sprouting up. That prompted a tremendous amount of new retail across the country. All of that stopped. Today, we don't have any of those dynamics in place that would prompt a huge material retail development wave. If you look at the cost of construction, I remember when I started at Lehman back in '01 and went to, I think my first property tour was probably '02 or '03, went to Dallas, and literally there were still cornfields like in the middle of Dallas. In Uptown, there was still vacant, big open vacant space. Generically in the Sun Belt, all that's gone, right? So when people are building apartments today, you still have to go further out. The timeline to build is longer. The cost to build even a basic garden style, so wood frame apartment, is 2x what it was a decade ago. The length of time to build plus the lease up time, you're talking about a 3 to 4 year period. So everything in real estate is more expensive. Everything takes longer. Private developers have pulled back because they can't get the capital. And the bid for existing assets that are well leased is really strong. Why? Because replacement cost is expensive. Nothing really new is being built today. Everyone wants the best product that they can find. Occupancies are healthy. And there's a big gap between in place and market rents, but it's not so big that it prompts new construction. So when you look at the debt side of the equation, even though the 10-year has rallied, fallen off, however you want to look at it in terms of yield speak, the spreads are really tight. And if you are a lender, you're a bond investor, historically, you have to worry about a glut of supply messing up your cash flows so that when you walk your bond into that REIT office in 10 years time, they tell you a sob story about all this new supply that's depressed their market and they're not going to be able to pay you back.
Just a quick question on the yield side. Now, we were talking about how we've seen the big sell-off in the space in July. Is that, do you think, predominantly a yield story, or is there something else going on?
I think, look, REITs had rallied hard. I think we're up on most, like maybe 18% year to date. And then in the macro world, you did have the 10-year that backed up a bit. I think that was part of it. I think there was also, if you listen to Craig Johnson and obviously Cantro, broadening out, you listen to what Nancy's talking about, the broadening out of earnings growth in this economy. And I think that people probably saw other parts of the economy that offered faster growth. And also if you say real estate's a derivative of credit in the economy, and if credit, the 10-year is backing up, that probably hurts REITs on the edge, on the margin. But overall, I think the reason why REITs are doing so well, and where I was trying to go with my long-winded story, is this lack of supply. And because it takes so many years to build, and right now we don't even have the ingredients to cause that supply wave to come about, it keeps pushing out further and further when that potential next development wave will swamp fundamentals. So for a equity investor, you're looking at strengthening pricing power on rents. For a bond investor, you're looking at increased comfort that you will get paid back because, one, the REITs aren't facing competitive supply. And on the lending side, the regulators are letting the banks work out problem loans rather than immediately jumping to foreclosure. And that's an outgrowth that started with the credit crisis, and it's extended since then. And I think that's been a positive for real estate.
With the 3 to 4 year build cycle, you're having to look pretty far out there in terms of the fundamentals. Where right now, when you're looking at what's on the horizon for the space, do you see, given the structural supply issues, strength to come? Because real estate has been the sector that hasn't necessarily seen the same earnings broadening out as some of the other groups, which makes sense because it is much longer duration.
I noticed the stat yesterday, so I wanted to just bring it up, that I noticed yesterday looking across sectors that real estate this year to date has seen the lowest earnings growth, its contribution to its return, but the most PE expansion of any sector. And so that puts it pretty much in the middle of the pack in terms of where it is year to date. So I just thought that was an interesting dynamic because this year has been very much an earnings story across markets and especially larger cap markets, but just to see that it's been really seen PE expansion, which has been what's lifted it so much this year.
No, Ellie, if you look at FFO multiples, yeah, but they're still well below where they were like pre-GFC. FFO multiples got incredibly stretched. You had many sectors that were trading at north of 20 times FFO. Today, most of them are mid-teens or low teens. What you're seeing in REITs is a confluence of events. One, for a lot of them, there's still 200 basis points of refinancing headwind, right? So your 4% debt that's rolling today at 6%, it's creating a 200 basis point earnings impact. So historically, if REITs delivered 6 to 7% earning, now you're 4 to 5%, right? That's one. Two, if you look at apartments, because of last year, still digging out of the oversupply, apartment earnings are maybe up 2, 3%. So that's it. Retail, which has gotten a better earnings profile, still only growing 4 to 5%. Some guys, if you can get over 5%, that's like a big number. Industrials are growing 6, 7%. Cold storage is flat. Office is flattish to a little up this year. Next year should be better. But the problem with office is all of the great leasing acceleration that we've had over the past 18 to 24 months. It takes 2 years for that to really translate to rent paying. So it's always a next year story. Next year, it looks like 27 is going to be that year that we finally see it falling to the bottom line. But I think, Emily, to what you're speaking about is the realization that this lack of supply theme that here at Piper we've been talking about for 4 to 5 years now, 5 years, is finally starting to play out. And so that when investors are modeling their numbers for 27, 28 and beyond, barring a cataclysmic recession or some government mandated shutdown, the growth trajectory is really good.
So would you say you're more optimistic here on the space than you were last time we did the podcast?
Yes,
September?
because last year REITs were not good. REITs haven't outperformed the broader market in years. And we knew that this lack of supply theme would eventually play out because it's just math. If you're not building anything, when everyone wants high-end properties, there's a shortage. It just takes a while to get there. And I think there was also nervousness here in New York over Mamdani. Was Mamdani going to kill the New York office sector? We didn't think so. We had to separate our views of Mamdani as a politician versus our views of New York office. And I think that's always important for any analyst, is to separate your views. But yeah, he has it. New York office has boomed. You look at the West Coast. A year ago, they were talking about AI in San Francisco office, but as a small player, taking a few spaces here and there. Fast forward a year later, it's consumed the entire Bay Area. It is night and day how quickly that market has rebounded, and people are referring to it like the dot-com era. The difference being that today's companies are much more financially put together and thoughtful versus sock puppets that we had in the late 90s. And now you can see that spreading to Seattle. We said Seattle is going to be the market of the year in 27. It tends to follow 18 months after San Francisco. You look at what's going on, and it's the same trends: lack of supply, innovation. And the other interesting thing is that this Iran war and Ukraine, what that's done for drone warfare, and you take AI and you marry that, we're hearing about aerospace and defense as a demand driver. In my 25 years in REIT land, never have I heard aerospace defense as a demand driver. Yet this year, it is increasingly coming up in conversation, because in Seattle, in the Bay Area, and then south of LAX in the El Segundo and that market, which is the home of aerospace and defense down in Southern Cal, that talent is merging with technology. And then that's spreading to other industries that want to incorporate the latest in this whole AI wave. It's incredible what's going on. Truly is. And that's why, and it echoes, and that's, we co-hosted an event with Nancy back in late May, but we are seeing in REITs what she's describing in her research, which is there is an accelerating economy that defies the macro. People are done waiting for the all clear sign. We're seeing office companies, warehouse. We just had a Sunbelt warehouse company on the road this week, East Group. They've leased more space since the Iran war than they've ever leased in their history. People are done waiting for the macro. They're looking at their own businesses, the demand that for their products, and they're taking space.
Well, that's really interesting. When you think about the macro, one of the things we always talk about is it's not just the direction, it's also the time. Things become normalized. Higher rates for longer become normalized. And then you can continue a macro cycle even though people may look at it like where rates are so much higher than they were, it's just the new normal. So that's really interesting. And I love how you brought up AI. That was going to be one of the questions on our list is how does AI meet real estate? And it's really interesting to hear how that's become a demand driver.
It is. As I say, a year ago, these tenants were just taking a floor here or there. It was topical, but it was nothing that was changing the market. Today, it absolutely has. I think on the recent earnings call, I think it was SL Green, said there's more, or maybe it's BXP, I forget which, but one of them said there's more AI demand in New York than there is in San Francisco from a pure leasing standpoint.
Wow.
But this was a stat that was thrown at me. The REIT said it, so it must be true, that 1 in 10 college grads comes to New York, which is why, for all the reasons we can say New York should not be working, it does, because you have that younger generation that just wants to be here. And as a result, you're a company, you want talent, you got to be in New York, despite all the craziness, the mishigash that we have. When you look at AI and then it's spreading to other industries in terms of the need to just think more innovative. And I think this is something, and I don't know if you guys have done anything on the macro side, but when you think about it, we haven't had really good inflation in 50 years. So for 50 years, businesses never had to really worry about their internal cost because they could always pass the price on whatever. You can't do that anymore. Customers are done paying higher prices, but businesses have to readjust to their cost pressure. And so you're seeing this dynamic where companies that overhired during the pandemic are firing. At the same time, they're clamoring for ever more and more office space. But it's as they make their businesses tighter and where they're bringing their talent and their workers is back to the office. And this is something that the apartment Essex, which is a pure play West Coast apartment REIT, said about a year or two ago when there was nervousness over some of these layoffs. They said the layoffs are not happening in the Bay Area. They're happening elsewhere where these tech companies overhired elsewhere. But in the hubs where the people work together, that's where the hiring is. And fast forward to 2026 and that in the New York leasing, in the San Francisco leasing, you're seeing that in Seattle. You're seeing that in Back Bay of Boston, you're seeing that urban hiring.
So given this dynamic from an investor's perspective, where do you think are the biggest opportunities in the real estate space?
Industrial, East Group in Torino, for sure. As I say, we just had East Group on the road this week. They started the year with 800,000 square feet of availability. That's now down to 300,000 square feet. Data center servicing tenants are 25% of their development leasing this year. And some interesting stats they cited is every million square feet of data centers in Texas requires 550,000 square feet of support space. And apparently the data centers are so voracious in the equipment that every 2 to 3 years, that equipment needs to be serviced and sometimes replaced. So these data centers are causing this extra demand on the system.
Ripple effect, right?
Ripple effect, exactly. Retail, as I say, there's no big wave there's no mass retailer development or new housing communities that are causing new retail to be built. And given the length of time it takes, we have probably 5 to 10 years before the next material retail wave comes back. Every brand knows that if you don't have a physical location, you're not growing. You can't be online only. You need physical. And there's not enough space to go around. So unlike years before, you're seeing tenants actually bid for bankrupt space on the courthouse steps. You're seeing tenants take space as is. You're seeing them take non-prototype space. Like all these, and I'm sure you can talk to our consumer analysts, all these brands have these growth plans to open 100 stores, 200 stores, there's not enough space. And the tenant credit today it's 60 basis points. Normally it's called 100 basis points, but we're at that 60 to 70. So when you look over the next number of years, industrial, retail, huge. I'm a big bull on office. Why? Because for the next 5 years at least, there's nothing new that's going to be built in New York. So unless New York suddenly rolls over and everyone gets laid off, the pricing dynamic is only going to tighten even more. And what's different about office that's never happened before is we've never had this cash NOI margin expansion, because normally rents go up, a bunch of new buildings come online, rents come back down, wash, rinse, repeat. Now rents are actually accelerating up. And that's pure cash margin to the bottom line because the free rent is pretty much unchanged and the leasing dollars are pretty much unchanged. So you're going to see office companies generate cash flow that is unheard of because of this expansion. It is a moment in time. It's for the next 5 to 7 years. And then we'll get new buildings built, some off the system. But we're in for something that people have never experienced before. That's why you can hear this enthusiasm in our voice. By contrast, apartments, I think, are going to be a little tougher. Politicalized. Andy was making the populist comment on in his latest research report. There's populism on both sides of the aisle. They're looking at apartments. Years ago, apartment CEOs could talk about pushing rents as hard as they can. Their tenants can afford to pay more. You can't see, even though they rent to upscale, we used to call yuppies. I don't know what the term is, but all the young office workers. It's an affluent base, but you can't talk about that anymore. You have to be more moderate. Plus, to our earlier conversation, years ago, I think people were willing to overspend on some tiny little studio in the cool part of town. Today, I think people are like, you know what? That doesn't work because all my other living costs are up. And I want to do travel. I want to go to concerts. I want to do all this other fun stuff that I don't want all my money just going into rent. So I think apartments, the growth dynamic has changed, probably decelled versus historic. But I think you're going to see earnings acceleration in retail, in industrial, and certainly in office.
I have a question for you actually on retail. You had mentioned 5 to 10 years before we get the next big retail wave. I guess I'm wondering what would bring that about? What would be the best case scenario for a big retail wave to happen from an economic standpoint?
I think what would cause it is that market rents got to a level that you could justify new development. And then you get, especially some of the bigger retailers who say, we want our prototype back. We have a set format of X. We're done taking this space, right? That's where I think you start to see that come back. And let's face it, the Sun Belt continues to see massive in-migration, right? So as those rings grow out, then those new areas, you need retail.
You need to build them up, right?
Yeah.
So you just hit on another question is what is the outlook for the Sun Belt? You've mentioned how real estate in general is a limited supply. They don't make land anymore. And there are multiple demand drivers today. So the Sun Belt had been a big build out for the last couple of years. Is that trajectory still on track?
Yes, absolutely. It's low cost, it's pro business, it's pro law and order, it's pro everything, right? So yes, it will continue to grow, just cost of living being the main factor. On the East Coast and West Coast, we don't build enough housing, right? It's incredibly in short supply. Texas is only competing harder for businesses that used to be California and New York, right? If you think about technology, if you think about finance, there are more Wall Street jobs now in Texas than there are in New York. If you think about medical, Houston has a huge medical community, and Texas is no longer just run by energy. So there's a lot of positives about that state that will continue to look. When you have the Attorney General in California suing a major Hollywood studio, would anyone be shocked that the studio is talking about relocating out of California, right? You don't see that in the Sun Belt. The states there aren't in the business of scaring away economic growth.
You were very optimistic about the space last year when we had you on. And it sounds like you are even more bullish about what's coming down the pipeline as repricing of debt rolls off. Some of these legacy things roll off and the earnings picture picks up.
That's a really good point. So if REITs have on average 10-year debt, that means we're about a little bit more than halfway through these legacy maturities that were a lot lower. So over the next sort of 5 to 7 years before that next generic supply wave comes, we're also increasingly marking all the debt to market. So that 2% headwind that the REITs are having in their earnings fades away. So again, as investors look over the next 3-4 years, the earnings outlook for REITs really brightens. The risk, of course, is a major recession, some sort of financial cataclysmic event that upends either the financing of real estate or the demand for real estate. But the lack of supply means that even if demand slows, it's not like you suddenly have a bunch of vacancy out there because you just haven't really put much new product on the market.
Thank you so much for being on. We have to have you on again soon, and we're not going to wait a year next time.
Yes, let's have him on before. It's been a solid 12 months. Thanks, Alex, so much. It was great speaking with you today.
Thank you, Stephen. Thank you, Emily.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.